Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. In this video, I'm going to go over the covered strangle strategy. I've been starting to use this with MES futures, but it's just going to be a generic video explaining the strategy, how to implement it, how to set it up, how to manage it. And it's a pretty straightforward trade where you could have a lot of flexibility in where you put your strike prices, your time to expirations, and you can make a pretty decent premium on these. The main thing is you want to be able to eventually acquire 200 shares or possibly two contracts of a futures contract. So if you're willing to do that and you see how the premiums are going to be able to get the amount of money that you want, then it could be a very useful strategy for slightly bullish, neutral, and if it's slightly bearish, it's still okay. As you can see, there's a lot of flexibility. So let's get right to it. Okay, so here we're going to cover the covered strangle. Get it? Cover the covered. Bad joke. All right. I've been running these on my website, thetatraders.com, and you can see the covered strangles that I apply into MES futures. And we're going to go over just the basic strategy of how to set these up. So objectives today: explain what the covered strangle is. We get some examples of how to set up this covered strangle, looking at some risk return graphs, and then we're also going to see how to possibly manage positions if they go against us. So what is a covered strangle? So the covered strangle is simply a combination of a covered call and a short put. So essentially you could buy 100 shares of stock. You could sell a call against it. That would be a covered call then, because if that short call gets assigned, your 100 shares of stock would be able to cover that position. You'll just sell your 100 shares. You're also going to add a short put to this. This makes it a slightly bullish strategy. You do want the position to go up a bit. Ideally, if you could get some capital gains by selling an out of the money call, and you could collect premiums on the covered call and collect premiums on your short put, that usually would be the best benefit. But you could also make quite a bit of money in slightly bearish markets, also neutral markets, because you're receiving premiums on the call side and the put side. So you'll be able to get twice as many premiums than if you just did the covered call in some situations. Obviously, the deltas matter, but you could boost those premiums over the straight covered call. So I think one of the most important things here for these is to only use this with stocks or ETFs or futures you're willing to own for a long time. You got to be patient with this strategy. Sometimes you might have a position for months. And you're willing to have at least 200 shares of the stock or two contracts. One of my friends typically does this by buying the 100 shares first at a price that he currently likes. He might want the second 100 shares to be a little lower cost price, and then he could sell the covered strangles against it then. So how do you set this up? Pretty straightforward. You're going to buy 100 shares of stock, and then you're going to sell a call. The call could be in the money if you want it to be. You'll get a lot of premium that way, selling in the money calls. You can sell it a little bit out of the money if you're a little bit more bullish and you think that the stock will go up. You can also get capital gains that way. So let's say I sold a covered strangle, stock price is at 50, and then you sell a 55 call against it. If it goes past 55 at expiration, you'd make that $5 capital gain as well as the premiums from the call side. You're also just going to simply sell a put, and I typically do 0.1 delta. You could do different deltas depending on what you like for a new price of the stock if you're going to be buying it. 0.1 delta doesn't get exercised too frequently, and you could get the shares as well at a pretty low price. If you go with a higher delta here, you might be buying 100 more shares of stock at a fairly higher price. It does give more premium though, so you want to look at the strike prices, see how much premium you're going to be getting for certain deltas, and then work on your own judgment on what you think might be the best deltas and strikes for that. So this is a profit and loss graph for the covered strangle. So if you're going to be selling a short call, stock price is at 200, and we're selling a 210 short call. On the call side, You'll be making money, obviously, if it stays at 200 because you took in money from the premium. If the stock price goes up, you're going to be making more capital gains here. And then you could max it out at wherever your short call price is. Your short put will be lower, and then your break even is lower than the $200 strike price because of the premiums you're receiving on the call side and on the put side. Your short put could theoretically have almost an infinite loss if the stock really tumbles, but at least you are taking in premium from both directions, and whatever short put strike price you're getting, you have to be willing to get at least 100 more shares of stock at that particular price. So how do we profit from this trade? You do receive premiums in two directions, the call side and the short put side. If your stock is flat, you're going to receive your full premium because the call side and put side would expire worthless. And that's a good benefit to have. If it's a neutral or flat stock, you could be making pretty decent premiums on it, just waiting. If the stock goes up, you're going to use your 100 shares. Assume that the stock goes up past your call strike price. You're going to use the 100 shares to cover the short call. So you're going to lose your 100 shares at that point, and you still receive your full premium on the call side and the put side. So the put side would expire worthless. Call side would take your 100 shares of stock, but that would be a very good benefit to have because you got possibly some capital gains and you got premium in two directions. If the stock goes down but stays above your short put, you would still receive your premium on the call and put side because they're going to expire worthless. And then you just do that trade again at different strikes, most likely. You could possibly be down after this if the stock goes down enough to be greater than the premiums that you collected. But in a lot of cases, if it's just slightly down, those premiums would be adequate to continue doing this strategy, I think. So how do you manage these in the different situations? How would you manage if the stock increases and you had to sell your 100 shares? In that case, you could just simply start over. Buy 100 shares again, sell the covered call, sell the short put, and then just keep that cycle going. Pretty straightforward if you lose your 100 shares of stock. You could consider rolling it if you want, but I like in the initial conditions to reach the profit targets that I'm looking for. And if it's able to do that by losing my shares, I should be happy anyway. Some people get a little frustrated or annoyed if the stock shoots up way past the call price because they could have made more money not selling the call. But I like thinking of it as you made your max profit, be happy with that, and don't really stress out about that. All right, how do you manage if your short put is worthless and you still own the stock? So the call side was expiring worthless here. In this case, you can sell another call. Ideally, you sell it at the initial price again. You don't want to have capital losses in most cases. You could sell it even higher for possible capital gains. If maybe earnings are coming out and you're still long-term bullish on it, maybe you could sell a little further out of the money on those. And then just sell another short put. So it's very similar to if you lost your 100 shares, you're going to start it over again. If both of these options expired worthless, you can just start it all over again, right? And then finally, how do you manage it if you get a sign on your short put? So if you go in the money on the short put at expiration, and sometimes even before that, if there's a dividend, you're going to own 200 shares of stock because you initially owned 100, and now you're going to get an extra 100 shares from that short put. At this case, you want to sell 2 covered calls because you do own 200 shares, and you want to sell it for at least above your cost basis. Your cost basis would be where you bought your 100 shares at, subtract the 2 premiums from the call and put side, and then whatever that price is, you're going to make sure that you sell at least 2 of them. For the 200 shares of stock, you actually want to average the 100 shares that you initially bought it at plus the 100 shares that you got assigned at. So let's say you got 100 shares at $100. That would be $10,000 that you put up. And then let's say you sold a 90 put and that gets assigned. You'd have to put up $9,000 more dollars. That would be $19,000, but then divide it by 200 shares to get your new cost basis. And you also want to subtract the premiums you got. So what's really good about this strategy is it would lower your average price of your shares if you get assigned on the short put. So if you're patient about it, you can still make quite a bit of premium. And in a way, it does lower the risk because you do have a lower average price of the shares. Again, you should be willing to do this with 200 shares. And don't get upset if you get those extra 100 shares. That is part of the strategy, and it's going to happen from time to time. So here's an example with Bank of America. Right now, the stock's at 31.70. You could buy 100 shares for 31.7 times 100, or $3,170. And then let's say you want to sell the November 18th call. If you want a little bit of capital gains, you could sell the 33 strike. Notice how the 33 is higher than 31.70. So you'll be receiving $1.30 in capital gains here if it goes past 33. And you can receive $107 in premium. This is a good return for $3,000. What you could also do is sell the 11.18. This should be the put, not the call side. That ends up being an overall credit of 1.42 or $142 divided by $3,170. It's a good return for a little over a month. So if you're interested in seeing the trades that I do, I'm doing these on MES futures. You can join thetatraders.com. Have a free 7-day trial if you want to test it out. We do covered strangles, very, very low delta strangles. Also do 0 DTE strategies on SPX and longer dated catch your puts and put credit spread trades. So again, I'm the investing teacher, high school science teacher, teaching others how to invest. Everyone enjoy the rest of your day and good luck trading out there.